Guten Tag, IB Econ. We have a new video today. It's the bee's knees by the big cheese himself, Mr. Linegar. Let's make history today as we jaw over our Unit 4 video, the global economy. It's our fourth unit. We're going over concepts 1 through 6. But first, let's do our daily punishment. What did the ranch say when somebody opened the refrigerator? Hey, close the door. I'm dressing. All right, kiddos, let's get started. We're going to talk first about international trade, free trade, and protectionism. Reasons for trade: it does lower prices. Consumers are able to buy less expensive products, and producers are able to purchase less expensive raw materials and semi-manufactured goods. It leads to greater choice for consumers and producers. It leads to differences in resources. Each country needs certain resources like oil, water, copper, but they may not have them domestically, so free trade allows them to acquire resources they need, and it allows for economies of scale. The larger a company is, the more ability they have to specialize and lower their cost of production, making the products they produce more competitive. Some of the gains from international trade continuing are increased competition. Domestic firms are now forced into competition with international firms, which leads to greater efficiency and benefits consumers. It leads to greater quality, availability, and variety of goods, more efficient allocation of resources. When trade is truly free without government interference, everyone involved benefits. It leads to sources of foreign exchange. When less economically developed countries or LDC countries trade, they're able to gain foreign currencies that allow them to access foreign markets more easily. For protectionism now, if free trade is so good, why do so many countries limit it? They want to protect domestic employment. Free trade can lead to structural unemployment. Governments tend to protect industries in order to avoid unemployment. One of the questions free trade advocates ask is whether it really works or it just prolongs the inevitable. You try to protect economies from low-cost labor. It's often hard for developed countries to compete against developing nations due to their ability to offer human capital at low cost. They might also not have labor laws. This goes against the idea of comparative advantage, however. The reality is, as comparative advantage for a good changes due to globalization, the location of production follows that comparative advantage. So free trade, that's why it happens. They want to protect industries so they can develop. We call this the infant industry, sometimes sunrise industries. Avoid the potential problems of specialization. Some countries do protectionism because they don't want their country to become over-specialized or over-reliant on one type of business. Over-specialization could lead a country vulnerable to shifts in taste and preferences in a global market. Some of the examples of this are Malaysia in rubber manufacturing and Ethiopia for coffee. Another argument for protectionism is that countries need to have their own domestic industry in cases of war or conflict. National security. Another argument for protectionism is dumping. That's when a country sells a large quantity of their resources at a price lower than the equilibrium price. It's even lower than the production cost. They do this to drown out the competition. Countries do have anti-dumping laws, but dumping is one of the major critiques that protectionist advocates have against free trade. Other arguments for protectionism is it could be used to impose safety, health, or environmental standards of goods being imported. This was being seen with trade between Mexico and the United States when it comes to the food trade. The European Union has also used protectionism to ban imports of beef that have not been treated with hormones. But however, the costs of meeting these health standards are very expensive for less economically developing countries. I'm just going to say LDC from now on. There's a high cost to meet these safety standards, like I said. Continuing on, countries will use protectionist mentality to raise revenue for the government. You do get the little revenue box. And they do it to correct a balance of payment deficit, which we'll be talking about. Their aim is to reduce import expenditure to hopefully increase the domestic consumption, which would benefit the balance of payment. Arguments against trade protectionism. It may raise the price for consumers and producers of the imports they buy. It's going to lead to less choice for consumers. Competition would diminish if foreign firms are kept out of a country, so domestic firms may become inefficient without the incentive to minimize costs. It may reduce innovation. It distorts comparative advantage, leading to inefficiency. Specialization is reduced, and this would reduce the potential level of the world's output. It can lead to trade wars or tariff wars, retaliation, and it hinders long-term growth. Remember, free trade does lead to long-run aggregate supply shifting. It does lead to long-run growth. So now that we got that out of the way, let's look at some of the diagrams. This first one right here is the most basic one you need to know. All the other ones are based off it. This is the free trade diagram. Right here, we have the supply domestic, SD, the demand domestic, the supply world, PWPE, and we have Q1, Q2. The amount being imported is from Q1 to Q2. The amount being exported is from 0 to Q1. The original consumer surplus was right here before free trade. The new consumer surplus is right here. It's gone up. The producer surplus used to be this, and now the producer surplus is only this. It has decreased. This right here shows the same diagram. I like this one a little bit more, but you guys have seen this before, so you probably know why. This is from the import perspective. Most of the time when we're doing, when we're talking about free trade, we're looking at it from the import perspective. Although there is a graph for the export perspective, it's this one right here. You do need to know both, but all the other graphs are based on the import perspective. Yeah. The next graph is tariffs. A tariff is a tax charged on imported goods, on foreign goods. It's meant to get increase domestic consumption of domestic products. It does lead to deadweight loss and inefficiency. This explanation right here, I'm not going to read this. It just explains what's going on. In this tariff graph right here, the new consumer surplus is here to here. The consumer surplus loses, it loses A, B, C, D, E, F. The old producer surplus was just this triangle, but now the producer surplus is this triangle and A and B. So the producer surplus has gained. The imports are going to be from Q3 to Q4. So the exports have increased. This box D and E are government revenue. Box C is deadweight loss and efficiency. Box F is deadweight loss, loss to consumers. This graph shows a similar thing. It just shows the consumer and producer surplus. You do need to know, be able to analyze these graphs and know who are the winners and losers and the results of these things. They all are super important. Next up is subsidy. Subsidies, I would say the most confusing one. I mean, it is what it is, though. So for subsidy, you have a parallel line right here. The only Q you need to draw for a subsidy is the intersection right here. For subsidy, the imports have gone from Q1 to Q2 to Q3 to Q2. We have the PW plus subsidy right here. You need to know that. That will make a little triangle, letter G, which is your deadweight loss. This right here, E, F, and G, is your subsidy box, which you can draw, but it's not the biggest thing. It's not one of those required things. But, I mean, it's nice to do. It's the subsidy box is not the PE box. It's this one right here. For the subsidy, we just have the thing we just went over. Good, interesting thing about subsidy is the consumer surplus does not change. For the subsidy, this consumer surplus is still the same. It is still A, B, F, I, J. The producer surplus, however, has changed. It's now B and C. There is overlap Consumers don't lose from a subsidy because it's just giving money to businesses. They're not raising the prices. They might lose indirectly because of taxes and having to pay more taxes for the price of the subsidy. But there is overlap between this. Again, you can draw the subsidy box. You just do need to know there is overlap, but it's not one of the required things. And the deadweight loss F is inefficiency. The next one is quotas, which is probably my favorite. I don't know why it's my favorite. It just is, so just bear with me. For quotas, you have the parallel line, but it stops at the intersection right here. That is going to be Q3. Q4 is going to be where the line intersects with DD, right here. The number of imports will be Q1 to Q3. When you do this, you'll have a little triangle right here. And when you do the dash mark from Q4, it'll make two triangles. Letter J is going to be inefficiency, and letter K will be deadweight loss, lost to consumers. Here again is the quota graph right here. It shows that the similar thing. For the quota graph, we have Q1 to Q3 as imports. Letter I will be deadweight loss efficiency. J will be consumer surplus loss. You do draw the consumer and producer surplus here. It's based on where peak quota should be, which should be right here. I should have written that in. But it's this box right here. The consumer surplus has decreased. The producer surplus has increased. Another thing governments will do for protectionism is administrative barriers. They could do red tape. When goods are being imported, they have to go through an administrative process. They can make this harder to try to prevent trade. Health and safety standards and environmental standards are another administrative barriers. And embargoes are another thing. You will sometimes have nationalistic campaigns against free trade to try to encourage people to buy domestic goods, buy American. You hear that argument a lot. So just in overview, arguments for for trade protectionism, protection of infant industries, national security, health and safety, environmental standards, anti-dumping, unfair competition, balance of payments, government revenue, protection of jobs, to allow economically least developed countries diversification. Arguments against trade protectionism. It's a misallocation of resource. It leads to trade wars. It leads to increased cost, higher prices, less choice. Domestic firms lack the incentives to become more efficient, and it reduces export competitiveness. Next up, we're going to talk about the free trade agreements and economic integration. Economic integration is where countries coordinate and link their economies, economic policies. They do this to decrease trade barriers. The different types of preferential trade agreements that countries can do is a unilateral trade agreement, where one country agrees to reduce tariffs or protectionism, a bilateral trade agreement where two countries agree to eliminate trade barriers, multilateral, where two or more countries agree to reduce trade barriers, or regional, which America and Canada and Mexico did under NAFTA, and they did again under President Trump, where they agree to eliminate trade barriers. We're going to talk about trading blocks next. For trading blocks, it's a group of countries that join together in some form of agreement in order to increase trade. They do this to usually create a preferential trade area. It gives preferential certain access of products for certain countries. The first type of a trading bloc is a free trade area. This is an agreement made between countries where countries agree to trade freely amongst themselves, but they can do what they want with other countries. So they don't have to follow the same policies to like country D. You see it right here. A custom union is an agreement between countries where the country agrees to trade freely amongst themselves, and they also agree to adopt a common external barrier against any countries attempting to import into their customs union. So right here, they're freely trading, and they have a common trade policy against other countries. A common market has all those similar things, but the other thing that it has is they allow for the free form of the free movement of the factors of production amongst each other. And a monetary union has all of those things, but they also have a common currency. So they just build off of each other. Here's a common market. Here's a monetary union. And here's a chart just showing it. Some of the advantages of joining a trading bloc: a great size of the market with potential for larger export makes the and economies of scale for producers, and they increase the scale of their production. It increases competition, leading to a greater efficiency. It could be stimulus for investment due to larger market size. If the countries are doing a free movement of factors of production, it could lead to greater employment. It could lead to foster cooperation and political stability. Trade negotiations are easier as members can join together and have a larger voice and more leverage in negotiations. Disadvantages are that a country might not agree with one of its policies. They by nature promote trade within the bloc and create policies that cause damage to other part of the countries not in the bloc. So trading blocs can actually do protectionism against countries that are not part of it. And as the economic integration increases countries can lose a degree of economic and political sovereignty. This is one of the big arguments that some people make against groups like the WTO, organizations such as the WTO and trading blocs, that the country loses their sovereignty. Speaking of the WTO, let's talk about the WTO. The WTO is an international organization that sets the rules for global trading and resolves disputes between its member countries. All WTO members are required to grant most favored nation status to one another, which means giving trade concessions granted by the WTO to another country granted by all WTO members. Not all countries follow that. Some of the principles of the WTO: non-discrimination, more open trade, predictability and transparency, encourage fair competition, more beneficial for developing countries, and environmental sustainability. Some of the limits on the effectiveness of the WTO: there's unequal bargaining power for member countries. Larger economies tend to hold more power and have more of a say. Trade rules can be unfair to developing countries. And there's been a larger developing number of trade deals negotiated outside the WTO, like the TTI, the TTIP, which America was originally part of under President Obama, but President Trump pulled us out of it. So there are also negotiations going on outside the WTO. All right. Next thing I'm going to talk about is exchange rates. Exchange rates was probably one of the more complicated things that some of you all have problems with. For exchange rates, it's the value of one currency expressed in terms of another currency. Currencies can be traded on the market like any other stock. This is done mostly by government, central banks, private commercial banks, multinational corporations, and other institutions. There's 3 different types of exchange rates you need to know, and you need to know how to be able to graph all of them. The first one is a fixed exchange rate. That's when a country pegs their currency to another country, and they want to have the same conversion factor. The next one is a floating exchange rate, which is where it's able to just shift based on supply and demand. And the managed exchange rate it's partially floating. Managed exchange rate has the coolest name. It's called a dirty floating exchange rate. And it's partially floating, but if there's a minimum and maximum ratio that it'll go to, and if it gets past that, the government will get involved and shift it back in the middle. So let's talk about fixed exchange rate. A fixed exchange rate is when a country pegs their currency to another country. And if the other country's currency changes, they will change theirs. If they want to increase it, they would do reevaluation of currency. If they want to decrease it, they would do devaluation of currency. The government will intervene to manage the fixed exchange rate. This right here is just going more with some examples. Here's an example of the fixed exchange rate. One of the things you need to know here, whenever you're doing the y-axis, this is exchange rate. So this should be like E1, E2. This is quantity of whatever currency you have. You don't have to do this title right here, but it's nice. The denominator is always the currency. So this is from the American perspective. This is the Canadian dollar to the US dollar, the exchange rate ratio. What else? For this right here, you would also want to... I would also suggest you do D $, D1 $, S1 $, dollar sign. If you don't know the numeric symbol, then I would suggest doing like just writing the word S dollar or SUSD, SUSD, etc., etc. The next one is the floating exchange rate. This one we'll spend the most time on. This is where currency is allowed to float based on supply and demand. And for this, it can lead to appreciation of the currency where the value shifts to the right from demand perspectives or shifts to the left from the supply perspective. Or it can lead to depreciation where the value of the currency falls. So like I said right here, just to know, this is the exchange rate diagram. You do need to know all this stuff right here. Please make sure you graph this correctly. But we're going to talk about the shifters. And we're going to go in detail about all of them just because some of you all had a little bit of problems understanding the exchange rate. The different things that IB has that cause shifts in supply and demand on the foreign exchange market is foreign demand for exports, domestic demand for imports, inward-outward foreign direct investment, inward-outward portfolio investment, remittances, speculation, relative inflation rates, relative interest rates, relative growth rates, central bank intervention. So let's talk about exports, imports first. Say we have country A and B. Country A demands country B's goods. There's going to be an increase in demand for country B's currency because they want to buy their goods. And then the one thing you need to know about the exchange rate is if you're doing it from two countries' perspectives, they always are related to each other. If one country's demand increases, the other country's supply will increase because they're supplying money into the foreign exchange market to convert it to the other country's currency. So there'll be an increase in demand for country B's currency and an increase in supply for country A's currency. They always are the same as far as increase, increase, decrease, decrease. Now let's do foreign direct investment. A company from country A moves to country B. They need to pay them in country B's currency. There'll be an increase in demand for country B's currency, increase in supply for country A's currency. Next, we're going to do portfolio investment. Citizens from country A go to country B to invest in country B's stock market. They're going to have to pay with country B's currency. Increase in demand for country B's currency, increase in supply for country A's currency. And obviously this can work if we're saying negative things, like there's a decrease, then it would be a decrease instead. The next one is remittances. Filipino migrant worker working in China sends his money back home to his family, his paycheck. There'll be an increase in demand in the Filipino currency because they need to pay them. They're paying their when their family gets their money back in the Philippines, they're going to be getting back the Filipino currency. And there'll be an increase in supply of the Chinese RMN, the yuan. What's going to happen is there'll be increase in supply in the Forex market, and that RMN is going to be converted to the Filipino currency. Remittances is something you should know. It's also a vocab term. Next one is speculation. People in country B believe country A's currency is going to appreciate. There's going to be an increase in demand for country A's currency and an increase in supply for country B's currency. Next one, inflation. Some of you all have trouble with this. Country A has high inflation. So that means country A's products are too expensive. So there'll be a decrease in demand for country A's currency and a decrease in supply of country B's currency. This would be the opposite if they had deflation. Interest rates are very similar to speculation. If countries will want to buy currency if they have high interest rates, so country A's interest rates increase relative to country B, there'll be an increase in demand for country A's currency and an increase in supply for country B's currency. Next one, country A is going through an economic boom period. They have more money to spend on imports. So there'll be an increase in demand for country B's currency because country A now has more money, so they could buy more imports. And there'll be an increase in supply for country A's currency. And if this was a recession, it would be the opposite. There would be a decrease in demand and decrease in supply. And central bank, just know how monetary policy works. The bank decreases the discount rate for country A. The interest rate decreases. So there'll be a decrease in demand for country A's currency and a decrease in supply for country B's currency. Hopefully this made it a little bit easier just going through all these examples for all of them. When the price of a currency increases, we say it appreciates. When the value of the currency decreases, we say it depreciates. Here are examples of appreciation. You see right here, it goes up. And here are examples of appreciation. It goes up. You don't have to do numbers like this. I would do E1, E2, E1, E2. And here are examples of depreciation. The last type of currency we're going to talk about is the managed exchange rate. This is where it's partially floating. We call it dirty exchange rate. There's an exchange rate that is managed, and there's an exchange rate that's allowed to float. And here's how it looks right here. And if you see right here, anything from here to here can float. But let's say D shifts from D to D1 right here. It's above the excess supply. It's too overvalued. So the government will try to increase this. The government will try to increase supply to shift it to the right to get it back within this range. So some of the advantages and disadvantages of high and low exchange rates. Advantages for high exchange rate is it leads to downward pressure on inflation. It leads to cheaper goods. More imports can be bought. Each unit will be worth more than it previously was. Domestic producers put under pressure. Domestic producers are put under pressure. It improves efficiency due to pressure from international competition. It does damage the export industry because our goods are relatively more expensive. Remember, appreciation is one of the things you need to know for Forex shifting. And if our currency does appreciate, our goods are relatively more expensive. There's going to be a decrease in demand for our exports, which leads to a leftward shift of aggregate demand. And just like that, it damages domestic industries. Possible advantages to low exchange rate: greater employment in export industries, greater employment in domestic industries. Some disadvantages is it makes imports more expensive. And this right here just gives a summation of the whole foreign exchange market. Really important. It's always on the IB exam. You'll at least see it on paper 2, if not something more. It was actually on a paper 2G just a year or two ago. Really, really interesting. It's not usually on that. So really, really important topic. The next one, continuing, the last thing we're talking about, the foreign exchange rate, is if the government wishes to increase the value of their currency, this is how the government can manage the exchange rate. They can use a reserve of foreign currencies to buy its own currency. This could increase or decrease the demand or supply. They can also lower the value of its own currency by using its own currency to buy foreign currencies. And they could also manipulate the exchange rate by doing messing with the interest rates. Last thing we're going to talk about today, kiddos, is the balance of payments. The balance of payments is the record of value of all transactions between the residents of one country and the residents of another country in the world over a given period of time. Countries want to have a balance of payment surplus. One of the things that some Americans are upset about right now is we're running a deficit in balance of payments for the current account, that is. The balance of payments is always zero, but our current account is running a deficit. Anything that leads to more money entered is considered a credit or positive. Anything leaving is considered debit or negative. We're going to talk about current account first. Current account is a big part of the account. It measures both the flow of funds traded into goods and services plus other income flows. It measures balance of trade in goods, exports, imports. It measures the balance of trade in services, revenue received from exports, minus the expenditures of imports. It looks at net investments, income. So this could be like profits, dividends from stocks, financial investment abroad. It measures the net transfers of money, often known as net unilateral transfers. So this includes things like remittances, foreign aid, and grants. And this right here is the formula for current account, which you do need to know. There have been math questions on the IB exam for current account where they gave you a little chart and you had to calculate like one part of this. They would just put a little question mark on one of these things. So you do need to know the formula for current account. The next one is capital account. Capital account is making up of net monetary movements or of lost actions such as transfer of goods and financial assets. Migrants entering or leaving the country. Debt forgiveness is one. Transfer relating to the sale of fixed assets. Gift taxes, inheritance taxes, death duties. Transactions in non-produced, non-financial assets. So that includes like rights to natural resources and sales of brands, copyrights, patents. Capital is by far the smallest account, and it's very niche. It's a very niche account. The last one is the financial account. For the financial account, it includes the net change in foreign ownership of domestic financial assets. It looks at the domestic ownership of assets versus international ownership. So the first thing we have is direct investment, foreign direct investment. So this is like when a foreign company buys property or they build a factory, something like that, that actually falls under financial. Portfolio investment. This is when you buy stocks from another country. It's not the profits from the stocks, but it's the buying of the stocks or bonds. That falls under financial. When a country borrows money from another country, that is financial account. And when a country exchanges currencies or exchanges gold or like metals, that is financial account as well. Just so you know, the way that we break down the balance of payments is the current account will equal the capital account and the financial account. And then there's a thing for net errors and omissions. You don't really need to know that much, but they do equal each other out. So when we do the whole addition, the balance of payment will equal the current account plus the capital and financial account. You add those things first together, and that will equal 0. These things will equal out. Balance of payment will always be 0. All right, kiddos, that's all I have for you for today. We are done. Until next time, deuces. Deuces, yeah.